Welcome to Financial Revelations. I am David Safransky, and you could reach us at joshua@epsf.com. If you have a question, you have a comment, you have a concern, you have something that you'd like us to talk about, we'd like to honor that request if you have one. A lot of people have been asking about the Federal Reserve and interest rates and mortgage rates and things like that, and we're going to talk a little bit about that. And you can follow us on Twitter at FI Revelations, FI Revelations. And I bet you think you know what I'm going to talk about today. Of course, our audience, probably smarter than the average audience. And so the Fed did raise rates 25 basis points, or 1/4%. And I bet you think I'm going to talk about that. But actually, you knew this was going to happen because I told you it was going to happen. So I'm not going to talk a lot about that. But what I do want to talk about is the effects of that, and I want to talk about what the Fed said next. So you're not really wrong, but you're not really 100% right either about what I was going to talk about. So when the Fed raises rates like that, mortgage rates did go up. They're into the 4s now on a 30-year fixed. If you have a variable rate loan, I would really, and you're going to stay in that house, I would strongly consider locking that variable rate loan into a fixed mortgage, whether it's 15 years or 30, totally up to you. I happen to like a 30-year fixed rate, and the reason is it gives you maximum flexibility. So let's say that you wanted to pay your 30-year loan off in 10 years. You can do that. The bank isn't going to balk at that. But if you take a 10-year loan and try and pay it off in 30 years, they will have a problem with that. They're going to come and get their house back, and you're going to have to give it to them and move out. So I like the fact that a 30-year loan gives you the lowest payment, which you could pay more on, and you could make it a 15-year loan or a 5-minute loan, but you can't do that with a shorter loan. So I like the maximum flexibility. And a lot of people, if you're getting... if you have a loan that's 3%, well, it's basically like you're stealing from the bank right now because inflation's at 8.5%, and I think we're going to get probably a 15% inflation print this next week because fuel prices will be in it after the Ukraine debacle started, and those are really high. So what I do want to talk more about today, though, is what the Fed said next. And what the Fed said about the next meeting. Now, there isn't a meeting in April. There's a meeting in May. And Fed Chair Powell said that 50 basis points is on the table. So 50 basis point rise is out there by the Fed. And so a lot of people are asking why. And it reminds me of the great philosopher Sergeant Gamble, from basic training 1987, Fort Leonard Wood, Missouri, Alpha 589th. And he would say, why, WHY? Well, there's a good reason why. One, we have really the highest inflation numbers that we have seen in 30 or 40 years. It's significant. And, if you break down where inflation is coming from, about 40% of inflation is from fuel. It's energy costs, it's electricity, it's gas, it's gasoline, it's oil, it's all those things. And this is not getting any better. In fact, it's going to get worse. Right now, we actually have worldwide demand is a little bit lower for oil because China is in the throes of their worst COVID outbreak since COVID started. I read that 300 people a day are dying in Hong Kong from COVID. They had a big anti-vax population there because they don't trust the Chinese government in Hong Kong. They have never told them the truth, and so they didn't want to take the Chinese vaccine, and it's costing them. A lot of people are dying. Consequently, they're not using a lot of oil because they're shuttered. They're locked in their houses right now. If China comes out of COVID before summer, gas will be $6 a gallon in Ohio. So imagine what it's going to be like in Boston and San Francisco. It's already over $6 a gallon on average in California. The thing with this is that the oil prices are really a man-made, self-inflicted wound by our administration. They did this on purpose. They want energy prices to be high so that you are forced to transition to alternative energy. I'm reading a book right now that I'm only like 10 pages into it. I love it already. It's called The Moral Case for Fossil Fuels. And one of the things they postulate is that we should be using more fossil fuels, not less. We are cleaner now than ever before. If you think back to the Industrial Revolution, there was no EPA. In fact, the EPA was born out of the Cuyahoga River lighting on fire. The river lit on fire. And that's really the genesis of a lot of the environmental laws in the United States today. We're cleaner now. We're using exponentially more fossil fuels today than we did just 50 years ago, and yet our environment is a lot cleaner. And it is the cheapest and the best energy that you can get. We should be using more, not less. This administration has exactly wrong, but that's pretty much how they've done every economic decision so far since taking office. You know, when Donald Trump was president in his last year of office, gas was about $2.25 a gallon. I paid $4.25 yesterday. $4.25 a gallon at Costco. So it was even higher in other places around there. So we have this massive energy inflation, about 40% of all inflation. And because it's not going away, what you get then, there's this effect. It's kind of like rolling a snowball rolling downhill and getting bigger as it goes. You have food inflation because of the supply chain. And when you get a strawberry in a store, it had to get there somehow. It didn't just show up. It had to be driven there on a truck, probably transported on a train. Maybe it was even flown in from some places, but it got there using fossil fuels. Fossil fuels are way more expensive. Your strawberries are going to be more expensive. And supply chains are still really constricted. There are places around the world that are still kind of locked down. Of course, we're not as locked down as we were just 3 or 4 months ago, and we're hoping that this the virus, the version of the virus that China has, is a version of Omicron. And if you've had Omicron or you've been around it, or you have the vaccine, you're probably protected from it. But I'm hoping it doesn't get here. Then there's Ukraine. Ukraine is a huge supplier of grain and fertilizer, as is Russia. Well, there's not a lot of grain and fertilizer coming out of those countries right now, and we're not even going to let Russia probably sell their grain on the open market once this thing is over, which I think it will be over. Rumor has it that the administration is pushing President Zelensky to take a deal. It's not going to be a good deal for the Ukrainians. It was never going to be a good deal for the Ukrainians. We never had in mind giving them a good deal, which is... It's a shame because we've allowed a dictator to dictate to the United States and the rest of the world. You know, the NATO countries that we have, I like to make fun of Germany and Europe and France and Italy and all that, but when we're together, we're quite a powerful force. We've allowed him to dictate to us what happens because we're afraid. So we have the fact that there's not going to be a lot of grain and fertilizer coming out of Ukraine. That raises the price of everything. Think of everything that grain is used in, wheat. And Europe is coming off of Russian gas. Now, if I were the Russians and I saw all these economic sanctions that were going on, I would shut those pipes off. And for some reason, they haven't done that, and the Ukrainians haven't bombed them, which leads me to believe that there's something we're not being told because it's such an obvious military target. I was in the military for 10 years. I know a good military target when I see one, and an oil pipeline is easy. Those are easy pickings. Most of them are above ground, so you could see them. You could hit them with a missile, a Javelin missile that we sent over there. And the Fed is on a 2 to 3 year tightening cycle. So rates are going to be going up for the next 2 to 3 years. There could be a pause in there from time to time if there's something economically dramatic occurring. And the Fed could even back up a little bit if there's something dramatic enough. But that's why I think that we're going to have higher interest rates, higher inflation. The interest rates going up are meant to slow down inflation, but it takes a long time to get these numbers to reverse. And because we're not going to increase our drilling and exploration of natural gas and oil here while this administration is in power, I think we have this for the foreseeable future. I think gas is going to be at least north of $3.50 in Ohio and probably closer to $4 for the foreseeable future. Now, for the first time in years, this is actually hard for me to say. It was hard for me to even write on the board as I was preparing for today, but I'm beginning to think that the Fed is aiming at a shallow recession to slow this whole thing down. That's why they came out with the 50 basis point talk. And they even kind of backed that up a little bit where they were saying, well, it could be at multiple meetings. So what if that is the case, and it may very well be the case, they've done this before, they have a history of it, and rates and inflation rates perked up so fast that I think we're just seeing the beginning of it, and they know that, and that's why they're probably aiming at a slight recession. But I think stocks can be okay, and the reason why I think stocks can be okay is because the reopen trade is still super solid. So there's $2.6 trillion in savings that isn't normally there. This summer it's going to be spent. I still like stocks through the end of the year. I like stocks through the end of the year because I think the seeds of dissent are sufficiently sown to flip the House and the Senate away from the Democrats, and that's going to be good for the markets. Now, I want to tell you there is one thing that would change my investment thesis. And when I say my investment thesis, what I mean is it would change the way that I'm organizing portfolios right now, and I would come out of some things and go into others if this one thing happened. That's going to be the subject of next week's Financial Revelations, is the one thing that could happen that would change my entire investment thesis going forward. And it's an important thing, so I'm going to want you to tune in for that. But if you have questions in the meantime, please, Joshua at EPSF.com. He's going to put it up above my forehead. There's a lot of room up there. And then at at FI Revelations on Twitter. I'll be honest with you, I don't like Twitter. I don't like social media. I understand that a lot of businesses use it to advertise, get their message out. I really don't like, I don't log into Facebook ever. Well, hardly ever. I don't like Twitter. I don't like using Twitter. I think that social media is the bane of our existence right now. I don't think it's helpful to society. In fact, I think it's very detrimental to society. But I still want you to contact me on Twitter if you want to. I look at it every day just to see what's going on. What I like, the one thing I do like about Twitter is that there's a lot of news that gets broke right on Twitter right there. And so if you follow a lot of news services like I do, it is kind of a nice thing to see. But as far as like getting my message out and all that jazz, I have no interest in it. I'm not going to advertise on Twitter. I've done polls on Twitter before. It's just, I think it's detrimental to society's growth. And probably I do think it creates a lot of anger in people because they want to argue on Facebook or Twitter. It's like telling somebody to calm down. In the history of mankind, nobody has ever calmed down when somebody said calm down. It tends to make things worse. So, but I want you to be looking at Financial Revelations for investment advice, not specific investment advice, but the idea around portfolios, what's happening in the economy, how to handle your debt. You know, some people are saying, well, rates are going up, I'm going to pay off all my debts. You know, even if you have a low interest rate loan, you don't need to pay it off. I would rather have some cash and some debt than no cash and no debt. So before you go paying everything off, talk to somebody who's financially savvy and see if that's a good idea, because if we do go into a minor, shallow recession, it's going to be important to have cash, and that's what I want you to have. I am David Safransky. This is Financial Revelations. And next week, I give you the one thing that if it happened, I change my entire investment thesis. Have a great week.